Hi there, welcome to Nepi Invest and welcome to another answer and reply video where I get to answer your questions and reply to your comments to the best of my ability. It is Saturday, the 21st of February, 2026. Time is currently 10:04 a.m. on a fairly humid day on the mid-north coast of New South Wales. I'll only be here for another 2 weeks or so before I move back to Brisbane. And one thing I discovered yesterday, because I make pizza dough every single Friday, and one thing I've noticed is some days pizza dough is a little bit more sticky than other days, and it does become a little bit more annoying when it's sticky and you're trying to make some pizza dough or put it into the base. And I discovered yesterday that humidity is really important when it comes, maybe not really, but it does affect the stickiness of dough or pizza dough. And the way to get around it is on those more humid days, you put a little bit less water in it. And I did try that yesterday and it did work. It was sticky, but it was not as sticky as it has been on these humid days. Anyway, you don't care about that sort of thing unless you're a baker. And if you are a baker, you probably already know that sort of thing. So let's get into looking and start answering your questions or just replying to your comments. Starting off with StewPercy, who stated, not really a question, sort of a statement of the ASX a week ago. I wonder if you removed all the banks from the ASX, how much would it really be down? Because it just feels like every stock's getting smashed. And yes, I did have that feeling about a week ago. However, we did have a nice little rebound during the last week. And if we have a look at the different indices, I am thinking that overall indices were up. If you go to XTX, up about 5%. Financials up 2.76%. Equal weighted would have been up as well, up nicely, 2.27%. Small caps up 2.29%. The only indices I think might have been down could have been discretionary and staples. Yep, both a bit down a little bit. Even healthcare had a nice little rebound, if you call 3.1% rebound or a nice rebound. But it did look like we had a good week, or it did feel like we had a better week last week. Now, nothing compared to the banks. And the whole reason that it does feel like the ASX is getting smashed, yet it seems like the XGO is near record highs, is because of the banks. And one of the biggest complaints about the ASX is too much concentration in banks and mining. And if you actually have a look at the biggest companies on the ASX, and fortunately enough, I have the list of companies right now on Market Index, it's just full of banks. In fact, five of the biggest 7 companies on the ASX are banks. 4 of the biggest 5 are. And the other bigger company in the top 5 is a mining company. So the only non-mining and banking companies in the top 20 are Wesfarmers, CSL, Gummer Group, Telstra, Transurban, Woolworths, Sigma Healthcare, and Brambles. I'll put QBE Insurance into financials, we'll say. Well, that's financials, yeah. Anyway, so not a lot of diversification when it comes to the top 20 in the ASX. Anyway, so banks do affect the XJO. They do affect the overall market. And when the banks are sort of detached from every other company, which was true 1 week ago, it just feels off. It just feels off. And that is exactly what happened. Now, that's just me saying it's just a feel and just trying to say you're right to be feeling like that. But there are a few ETFs that do address the problem or the perceived problem that the ASX is too concentrated in banks. And those 2 ETFs are the X20 and the X20, which is ticker EX20. So this is all those companies on the ASX that are not in the top 20. So you want to become a little bit more diversified and you don't want exposure to those big banks because those big banks aren't growing, even though a couple of them had a nice profit growth in the last quarter. The question becomes, is that sustainable? More than likely, it's not. They're probably more than likely to be growing at the max rate of inflation, sort of like Woolworths. Anyway, and they're also quite overvalued right now. So you don't want that exposure to the bank. So maybe the BetaShares Australian X20 portfolio diversify is for you. And it's actually a nice little chart. This is a weekly chart. It has pulled back a little bit from the highs, but not significantly. So from the highs back in September, Yeah, it's down about 8.9%. Well, that was at the lows, only down 7% from the highs to the current level. So nothing too bad there. So the X20 looks like it's liquidly traded off. The other one is I'm trying to remember what the ticker code is. It's an X banks and no, I think it's X financials and mining. So you don't want any exposure to banks or financials and mining because you believe the ASX is too concentrated in those sort of industries. And I think the ticker for this one is OZXX. Yes. So Global X, Australia X Financials and Resources. This one has pulled back a fair bit. So this would be more correlated to healthcare and tech. And those those indices or sectors have been significantly affected over the past 6 months. In fact, this particular ETF has dropped 15%. I thought it might have been a little bit more than that. So that is correction territory, almost getting towards bear territory, but a nice little pullback. It's getting to the levels we saw back in April. This one hasn't been around for long. In fact, only since April 2023. And if we go to have a look at the daily chart, it does look like it's illiquidly traded, doesn't it? And yeah, so that's probably maybe one reason to stay out. It is illiquidly traded. So anyway, so just based off that, those a few ETFs, we have seen a fair bit of weakness in the ASX, and I think if you take out the banks, overall we would not be feeling good. But overall, most of us are not feeling good because we have seen most companies pull back, particularly tech and health. Well, depending what company you're talking about. Okay, so thank you for that, StewPercy. Next, we are talking about WiseTech and ProMedicus. Motivational Flavio suggests they're getting to a buy level finally. So let's delve into WiseTech and ProMedicus. Funny enough, I was looking at ProMedicus yesterday because I was comparing the P ratio of ProMedicus to Guzmán Gómez. In fact, I did a tweet on this. I sent 2 tweets yesterday. 2 tweets yesterday. How do you find your tweets? I have no idea. 2 tweets yesterday. First one was about EVZ, which I'm not even sure I discussed in yesterday's daily take. But my tweet, by the way, my tweet on Ausco Healthcare, almost 2,000 views, 18 likes, so that was going good. But I did a tweet on ProMedicus versus Guzmán Gómez, and ProMedicus, based off the PE ratio, is cheaper, and that is not including the abnormal high profit for ProMedicus because they had that inflated reported NPAT because of their change in valuation of their holding in 4D Medical. So if you take that into account, their P ratio is still below that of Guzmán Gómez, and I find that astonishing. Anyway, 1,400 views, 15 likes, there you go. Anyway, so I was having a look at ProMedicus and Guzmán Gómez. Have a look at that tweet if you really, really want to, and maybe you can criticize it if you really, really want to as well. But let's have a look at WiseTech and ProMedicus. And what I'm going to do is I'm going to also have a look at the P ratio of both. Oh, they can't look at the P ratio of ProMedicus because it's really low, 50. Yeah, really low for ProMedicus because of that abnormal high profit. And anyway, so this is the weekly chart for WiseTech. What I'll do is I'll put in the 200-week moving average. And the old saying, I don't know who made it. If you buy high quality companies when its share price is at the 200-week moving average or below, more than likely you'll significantly beat the market. And right now, WiseTech share price is significantly below the 200-week moving average. P ratio of WiseTech is just above 50, which is abnormally low. I do know that. And I have been thinking about adding some more shares of WiseTech. In fact, there's a question I'm going to be talking about later in the video about this very question. Am I adding to my positions in these companies? I did take profit when they looked overvalued. They look cheap now, so maybe I should be adding to my position, sort of following the old Warren Buffett adage, be greedy when everyone else is fearful. And it does feel like we're in those times right now. So what I'm going to do is I'm going to go to WiseTech. And what I'm going to do is have a look, and goodly enough, I actually do have P ratio here. So what I'll do, by the way, this is the income I don't need to look at the gross profit. This is the income of WiseTech over the last 10 years. Actually, does not include 2016. Last 10 years, although we don't need to look at 2016. Nice growth in profit. But the thing I want to look at here is P/E ratio. So this is going back to 2017. P/E ratio right now of WiseTech is around about 50 or so. And the only time in the last 10 years a P/E ratio has been below these levels was during COVID-19. Remember that panic? P/E ratio of WiseTech got as low as, look like 37. 37. Yes, 37. So it's near those levels now. So this is, I would say, peak panic for WiseTech. The next lowest was back in July 2022. So that was during the rising interest rate environment. People selling out because these companies, a lot of their profit is in the future. So you discount those profits a little bit more in a high rate interest rate environment. And the P/E ratio of WiseTech got as low as 65. It has been as high as 160 a few times. And that was peak optimism times, twice in the past 5 years. I'm going to ignore pre-COVID-19 because the P/E ratio of WiseTech got to as high as 200. Okay, so just by looking at the P/E ratio of WiseTech right now compared to historical levels, it does look attractive, and you can definitely see that just by the chart. Share price, there was a nice little bounce as well from the lows of 13th of February. So maybe, I'm not sure if this is the lows, but just based off valuation, I think you probably more than likely do fairly well with WiseTech over the next 5 years if you buy now. More than likely, not an absolute. Now, if we have a look at ProMedicus, you do see, if you didn't know anything better, you'd go, wow, ProMedicus is ridiculously cheap right now. So P ratio 56, and it has not been this low since 2017 when the P ratio was at these levels. But in saying that, you do have to be a little bit aware that the P ratio includes earnings, and the P ratio is not discriminate between underlying and statutory earnings. And if you have a look at ProMedicus, get the ticker right. If you have a look at ProMedicus's results, and we'll have a look at the half-year accounts, the thing that really stands out, and we all know this, or hopefully most of us know this, if you have a look at the profit and loss statement, there's a big attributor to their profit, and that is fair value movements on other financial assets. $149 million. Now, the tricky thing about this is they had a significant gain or fair value movement on their 4D Medical holding, and that also affected their taxes. They paid $72 million of taxes. Last year, only $21 million. So remember, who was it? Which country introduced a tax on unrealized gains or something like that? This is sort of similar. They're being taxed on unrealized gains. These are not gains. They're not realized gains. The fair movement of the value of 4D Medical. So you can't really look at, and funny enough, they did. If you have a look at their media release, if I can find it here, they told us the reported profit after tax, but the underlying profit before tax, not the underlying profit after tax. And I think the reason behind that is because of the taxation reasons. I just don't know what their underlying profit after tax would be because of those higher taxes. Anyway, so be aware of the P ratio right now of ProMedicus. It is not 50. I think it's more likely to be around about 80 or 90, but I just don't know right now. But if you just do assume it's like 80 or 90. The last time it was this low was back during the COVID-19 financial panic. Ever since then, the P ratio, got to 96 back in June 2022. So when I bought shares in ProMedicus at $55, the P ratio was over 100, and I thought it was expensive. Yeah, the share price has more than doubled since then, even though P ratio is 56. So about 80 or 90. 56. So I do think ProMedicus is attractive. And if we have a look at the chart, the share price has pulled back a fair bit. In fact, what I want to do is have a look at how much the share price has pulled back. So for ProMedicus, the share price has pulled back from the highs, has pulled back 66%. I actually did think I made a mistake selling half of my ProMedicus shares when the share price was getting to those levels. It did look really expensive, and now it doesn't. And if we have a look at the weekly chart, again, the share price of ProMedicus has not been below the 200-week moving average since 2013. On occasion, it gets very close. Got very close during the COVID-19. Got very close in June 2022, and I bought just after that. And during those events, the P/E ratio of this company was well above 100. So there is definitely an argument that ProMedicus is really attractive at these levels based off the significant growth this company is going to experience over the next 5 years. And this company would not be affected by AI at all. In fact, they could benefit from AI. They could even, maybe even increase their margins. Maybe I'm getting a little bit too biased. Maybe not. I think that's true. Okay, Chris, Alcidion at 10 cents might be time to buy. Funny enough, this is a question I've been asking myself for a while. It's very close to 10 cents, and I've been thinking the company is moving into their better period in terms of cash flow. If we just go back to the daily chart, and with the little pullback to 10 cents, I was thinking to myself, oh, now's the time to buy. And I did not hit the buy trigger. The share price is moving nicely along the 200-day moving average. They don't usually look at the 200-day moving average when I'm looking at the daily chart, but it's doing nicely there. So just based off that, I think this is a nice sneaky buy and really good volume when they release their results, their most recent financial results. So I'm still thinking about it. I just haven't hit that buy trigger. It wouldn't be as much a trade as a longer term hold. So thank you for that, Chris, for just reminding me that sometimes I don't hit the buy trigger. Paul on mail. Didn't you pick up Life360 recently results? Did you exit that trade on its further falls? Yes. This was a quick get out. And I have learned from this. It just shows you that even if a company releases something really good, and it was good, that sentiment in this space is so negative that people just hit the sell button. I can't handle it anymore. Sell, sell, sell. And the share price of Life360 has dropped since then. I would even think that this is also a little bit of overreaction from the market. As someone might say, this is just, if it's tech, sell. If it's anything to do with tech, anything to do with AI, just sell and then ask questions later. So share price has dropped 61%. Now, the reason this is a mistake, I just thought this might be more like a V-shaped recovery. They released something on the 23rd of January, share price up 27% on that day. I thought, yep, it's going to be a turnaround for the company, and the share price has dropped a fair bit since then. Now, the reason that was a mistake is because there was so much negative sentiment. You just see it in the chart. Look at that negative sentiment, share price in a well-defined downtrend. And previous times when the company has released something positive, the sentiment was actually starting to shift already. And my very first trading position in Life360 was done on the 1st of March 2024. Share price on that day rose 38.5%. And people would have been saying, oh, no, you're too late, you're too late. And the share price went on a really good run after that. Beautiful, beautiful trade. In fact, I added to my position not long after, I think it was the 8th of April. I added to my position, share price 16% up on that day. But if you have a look at the chart before the rally, there wasn't any significant negative sentiment. Maybe a little bit of negative sentiment back in December 2023, but that sentiment had already shifted, and that's why the share price could rally, because there was not much negative sentiment in this space. And then recently, there was another jump up in share price on the 13th of May, not that long ago. Share price on that day went from 24 to 26, up 13.96% on the day, and it was a really good rally until the peak was reached in October. Anyway, so that was my mistake with Life360, just thinking a good result or a good announcement could overcome the negative sentiment. And I'm now really understand that you need to see a shift in sentiment, I think, beforehand. You need to see a shift in sentiment, sort of like we did back in May. There was a shift in sentiment. Remember, the whole reason Life360 share price dropped in April was because of Trump tariffs, and that went away. That went away, and that's why the share price was rallying before they released something good in May. Anyway, so lesson learned for me is just because the company releases something really good doesn't necessarily mean the share price has stopped the downtrend. This was not a trend killer event. I think the sentiment was just too bad, too negative for that to be overcome. Thank you for that reminder, Paul and Mayo. Thank you. Richard Wilson, talking about Meeka. I had a small position in Meeka, which I sold on the quarterly update. What concerned me was that they had failed to inform the market at the time when the production was offline for over a week. I do remember reading about that and being a little bit surprised. You have to wonder if they had been down for longer, would they have informed us? I hope they would have. But Richard also says the lack of transparency just seemed like a red flag to me, especially given how prompt Meeka has been informed the market of their positive developments. Also, on the day they released a quarterly, the price of gold had gone up considerably, and yet Meeka's share price was flat. This caused me to worry the strength in the gold price might be masking any reaction from the market to the quarterly, and if the gold price pulled back, Meeka's share price may drop away. It now seems to have done this, but not necessarily for the reasons I sold. Quite the novice investor, so my thoughts might be completely wrong. Cheers. Anyway, so Meeka Metals share price, I think it might rally tomorrow, no, on Monday. And the reason I say that, I have a feeling gold was up. Gold is above 5,100. Yeah, gold is up. It's getting very close to a breakout. In fact, oh, it could be breaking out right now as I speak. Anyway, so maybe Meeka will have a pretty good day on Monday. Unless it's a public holiday. I don't know why there will be public holiday then. But this is the chart for Meeka, and this is the one concerning thing. Share price had pulled back a fair bit. And when they did release their update, yeah, the share price had pulled back. I was like, oh, this is actually looking fairly weak for a gold company. And we haven't seen much buying come since then. So very close to a sell. But we did see, or we have seen in the past, that Meeka Metals share price just goes sideways for a period of time. Between April and August, went sideways and then nice little uplift. But I'm not sure about this chart. But I think the share price should go up on Monday. And everything else you said is someone who would look more deeply into a company. And for instance, this transparency, I did actually notice that. But for me, that was not as important. I don't consider Meeka Metals to be a longer-term hold. In fact, I think it's more of a trade for me. And I have traded out of Meeka Metals, by the way. Deploy the cash to something else. I am Ika. Yes. Thanks, Snappy, the way you answer with such simplicity and depth. Much appreciated. We'll definitely work on plan strategy on all buys. A question regarding the active ETFs funds. Can you please have a look at PGA1 and Pangana High Conviction Class A, B active funds? Okay. What I'm going to do, I think, based off your... There we go. PGA1. So I did have a look at this before I started recording, just because I was like, ooh, I wonder if one of these is listed. So Plato Global Alpha Fund Complex. And what I do or would do if I was more interested in this space is go to their website or have any look at any sort of information. So because this is listed, they do have December update. December 2025 investment update, and what they should have, I think, in this one. By the way, I noticed when I was going through this, Pinnacle. So is this a part of the Pinnacle? PNI. Must be. So they are owned by Pinnacle, because Pinnacle is a fund manager of fund managers, I think. Anyway, what I like about these sort of announcements is they talk about like the ticker code and their strategy, how long it's been around. So inception, September 1st, 2021. Available on the ASX from November 25, 2024. They're a long short, looks like. 148 long positions, 49 short positions. I'm not sure what the percentage is there. Talking about volatility, beta, Sharpe ratio, etc., etc. Performance, and it seems like they do really well over the last 3 years, 38.25% versus a benchmark of 21.85%. And value added. So they're doing really well over the last 3 years. Growth of 10,000 since inception, and it's from 10,000 to 25,000. So they're doing really nicely. Now, the most important thing is what they invest in, and their biggest holdings is like my biggest holdings as well when it comes to USA. So Nvidia, Apple, Microsoft, Amazon. The only one I don't own here is Broadcom, but I own Alphabet, Meta Platforms, Tesla. I used to own Eli Lilly, but I sold out of that one. So the way I look at this is I already invest in their companies I invest in. But they're a little bit more diversified than that. So you can see the best performers include companies like Luden Gold, don't know anything about that, CMOC Group, 3S Bio, King Cross Gold, so they like gold, HBM Holdings, and the worst performers include Westgold, Resources, Salesforce, and Apple, plus Endeavour Silver. And also got the top 10 countries. Anyway, so that's something you can trade actively on the ASX. The other two here, however, are not. So if you go to the Plato website, have a look at their funds. Oh no, maybe that's the wrong website. Let's see if I can do this now. Yeah, here it is. Pangana Capital Group, higher convictions equities funds. They have a Class A and B. They also have some other funds here you might want to look at. Global Small Companies Fund, Emerging Companies Fund, also have specialty funds including private income, sustainable impact, already talking about the high conviction, Alpha Israel, and diversified private credit. So what is a high conviction? Now, I saw this and I just assumed that they don't put a lot of companies into this particular portfolio. That is what conviction means. You have high conviction on these companies, so less diversification. And that is exactly what it is. So high conviction equity fund invest in a concentrated, that's a good word, ethically screened portfolio. I don't really care about ethically screened, of not more than 20 Australian and global companies. So that's why it's conviction, not diversified because less than 20. What else is important here? Strong competitive position, significant discounts of fair value, under research, out of favor, hidden value, cash flow generation or strong balance sheets, which is interesting because I had a look at their biggest holdings. Quality of management, aligned incentive structure. High conviction, maximum 20, small mid cap, Australian overseas. And then if we go down, really good performance for their fund Class A since 2014. In fact, if you put $100,000 into this fund in 2014, it's gone from $100,000 to $1.45 million. That's a nice return over a 12-year period. Their Class Bs haven't been around for very long, since 2020, and $100,000 has gone to $314,000. So they've done well. What's the difference between Class A and Class B? It's different fee structures. They do mention it somewhere. Here, yeah, Class A is just a different fee structure. So management fees, yeah. Class A for investors who prefer a lower performance fee with a base management fee. The other one is prefer a lower management fee with additional fees incurred for higher performance. Anyway, so they've done really well. And then I had a look at some of the companies they're invested in. Atria, Brazilian Rare Earths, Clarity Pharmaceuticals, Hyperion X, and Metallium. And they're all story stocks. I don't know what they're talking about here when they're saying cash flow generation or strong balance sheets, because these are all story stocks. None of them, I'm assuming most of these aren't producing much revenue right now. So it's interesting that this is 5 companies in their portfolio. Interesting. But they've done really well. So how am I to criticize them? I just found it really weird that these are the 5 companies they've got on the website. They're top holdings. It's interesting. The other thing I realized when I went through this, I can invest in this in my super. Yeah, because the reason I say that is because, where is it mentioned? It's mentioned, here he goes. Platform Availability, Apex NZ, Hub24, Macquarie Wrap, Mason Stevens, and Net Wealth. And I invest through Net Wealth, my super, and I had a look just before I started recording, and yes, I can invest in this fund. But I do think I have to invest over $10,000. Yeah, minimum investment, $10,000. I recommend time frame 7 or more years, but they do perform really well. Just saying. This other one, what was the other one? PGA1. Let's have a look at the chart for this, PGA1. If this is the same thing, and it's doing well. Thank you for that. I am Ika. Talking about Meeka, as you mentioned, you're increasing your cash levels. How do you plan to redeploy that cash? Will it be once you see a clear shift in market sentiment, or would you like to allocate it to other companies in sectors that are less affected by the current conditions? Okay, so I just let my trading rules dictate what I do. So I'm always looking for new trades, but if I get a sell signal for one of my trades, I just sell that. And that is why my cash flows have increased, because a few companies I've sold. And I'm just actively looking. Recently I've bought 2 companies. The most recent additions have been Amcor, and this one is just based off the chart. And the other one was Horizon. And this one has just gone bonkers. Look at the volume, massive volume coming through. They released results. I was trading this, got out, back in, released results, and this was a nice little confirmation of the uptrend. But the volume is interesting, massive volume coming in for Horizon. So that is what I'm looking for, and I'll go through all my watch lists and just see how the market has reacted to some of these results. And I am thinking of adding to my tech companies in my super, so that will decrease my, when I say $100,000 in cash, I mean outside of super, but I have a fair bit of cash in my super as well, and I will add to that more than likely. So my super is, I don't really trade my super all that much, but my out of super, non-super, I do trade that. So my cash levels will go up and down a fair bit. I also want a little bit of cash on the side so I can do like landscaping for my house, buy some stuff like a big TV, and I need to buy a fridge. What else do I have to buy? It's really a TV, fridge. I want to do the outdoor landscaping. Have to do the patio, the veranda. Have to do the what do you call the top of that? Not the top, the decking. The decking. Sensei, did you buy RGC, Nasdaq, a few months ago, and are you still holding? Thoughts on the 1-year chart? I was like, what is this RGC? And then I had a look at the chart and I went, oh, I remember this one, RGC. The share price went bonkers back before I went on leave, June. Absolutely bonkers. And I think I did a video on it saying I don't think the share price, this was just a bit of a hype, and I don't think the share price will stay up. Then I completely forgot about it, and the share price did collapse. And then for some reason, share price went bonkers again back in January. Share price has collapsed again. Not as much as before. I have no desire to buy this or trade this company. This is a story stock. I have no desire at all. Maybe if I was trading it, but even then, you can just see the shift in sentiment happens like that for this type of company. And that's all I really know. Maybe they're doing something really good. If I remember correctly, they're doing something with Chinese medicine, traditional Chinese medicine, and yeah, not that interested in that sort of thing. Yeah, development and commercialization of traditional Chinese medicine for the treatment of stuff, which, yeah, anyway. So maybe they can do well, maybe not, but I haven't seen any signs that they will do well. And this looks, to be honest with you, more like a meme stock than anything else. It looks more like, talk about AMC, which Amcor, but AMC Entertainment Holdings. This was a meme stock, and look what's happened with this one. Look at that. This is all nothing to do with the business at all. It was just a meme stock. Share price went all the way up to $380 and is back to $1.20. So I have no interest in these sort of companies at all. Paul says, hi Neppy, are WiseTech, Telix, and Neuren Pharmaceuticals good value for medium and long-term investments? Well, that's up to you. I've already mentioned or talked about WiseTech. Telix and Neuren Pharmaceuticals, good value for medium long term. So I actually own all 3 companies. Now with WiseTech, I bought some, then I took a little bit of profits. I would consider WiseTech to be a high quality company. And with the pullback, I'm really interested. Telix and Neuren Pharmaceuticals, I wouldn't consider these companies to be high quality just yet. I wouldn't say I'm concerned, but there is one little problem that they don't have diversification in revenue streams. So they are reliant on like one product, that sort of thing. Telix has diversified a little bit, but Neuren is still reliant on that one product, Debut, that is sold by Arcata. primarily in the United States, I think. But they do get a lot of money from that. And I just like a little bit more diversification in their revenue streams before I'm willing to call these companies high quality. However, the share price of both have pulled back a fair bit. I do think it's a significant overreaction. Telix released the results yesterday. I think it was yesterday, wasn't it? Share price has popped up. That's a nice chart, but that's a little bit ago. So share price has pulled back in the last year. In fact, the share price has dropped. In the last year, the share price of this company has dropped roughly, we'll say about 70%. And I think this is just an overreaction from the market. I remember back in July, just listening to someone, was it Marcus today? And the only reason they sold out was because the chart was looking weak. So when you have people selling out just because of technical reasons, you do see a little bit of weakness. They did release a few negative things, but it wasn't significantly negative. And the share price has got to the point where I do think there's possible value in this. Now, the reason I'm saying I wouldn't call it a high quality company, if I did call it high quality, if you have a look at the 200-week moving average, has fallen below that. So you could say maybe there's value, but you can't really look at the financials just yet and say it's value or good value because it's just recently profitable and revenue generating. Growth has been fantastic. And they've got a lot of potential tailwinds, but they could also be potential headwinds in the future because they have a lot in their pipeline. But if they hit a few, they get a few positive things in their pipeline, I think the share price will go crazy. Anyway, that's Telix Pharmaceuticals. Neuren, again, they're relying on the one product. If Acadia release, if you have a look at Neuren Pharmaceuticals, and their most important announcements have been in regards to, where is it? If I can find it here. We'll go have a look at the 1 year data. Whenever you see a bit of an update from Arcadia. Here we go. So on the 6th of November, record debut net sales, 101.1 million in the third quarter. And I'm pretty sure the share price of Neuren jumped on that day. That's the most important thing for Neuren is how debut sales are going, just because they're reliant on this one product. Now, in saying that, I do own shares, and I will always own shares in Neuren. So I bought back in late 2021 at 320. I have taken profits, but I decided just to maintain a long-term holding in Neuren because I do think they have a lot of long-term potential. If we just focus on the 200-week moving average and the weekly chart, share price is below that level. Last time it was below this level was a great buying opportunity. Well, maybe not, but share price got as low as $9 and then rallied back up to 22. On the daily chart, so I'm more likely to look at the daily chart for this one. Share price did drop because, what was the reason? I forget. And I think that was a little bit of, I wouldn't say panic selling. What was it again? Oh, the Neuren receives USA FDA meeting feedback. I think that was a bit of a reaction from the market. It's just feedback from the FDA. It's going to delay their wants by a little bit. Anyway, so for me, this is all about your thoughts. Telix and Neuren, all about your conviction about the future of these companies over the next 5 to 10 years. And in the meantime, you're going to see a lot of volatility. And so I treat these companies a little bit different than WiseTech. So even though the share price of Telix has pulled back a fair bit, I'm not adding to my position because I would have considered high quality. WiseTech a little bit different. High quality, I think there's a lot of value right now, if that all makes sense. Hopefully it does. But the answer to your question is, it's up to you. What is your thoughts on these two companies? What are they? Happy now. What's worse than horrendous? Thanks for another video. What is worse than horrendous? Atrocious. Maybe it's atrocious. You know what sometimes I like to do? Sometimes I just like to be stupid and I don't even have Gemini up here. Anyway, so I would say atrocious. What's worse than horrendous? Atrocious. There we go. Top tier, more extreme synonyms include atrocious, diabolical. That's a good one. Ghastly, hellacious, unspeakable, abominable, highness. I'm not going to say this abominable because I just can't pronounce it. Highness or heinous. I like diabolical. And ghastly and hellacious. I like hellacious. I might try to use that word if I can remember in the future. Thank you, Happy Now, for just taking me down that really weird path. Ben Hutchinson, thanks, Nappy. I hold Jumbo, Austin Engineering, and Lifestyle Communities for what it's worth. More on fundamental valuation grounds. Lifestyle is, I'm pretty sure that's Lifestyle. Am I mistaken? I'm pretty sure that is Lifestyle. Yep, Lifestyle Communities. But he does mention that the company is now led by Henry Ruiz. And I would not know anything about this because I don't really follow Lifestyle all that closely. But anyway, Henry Ruiz is ex-head of strategy at REA Group and someone I rate highly. So Ben Hutchinson obviously is one of those investors who will look at management and look at people, which is a very valid investing strategy. Look at the people, look at the management, and I think you'll do really well if you have that strategy. I do look at people, but I generally don't like people. So, well, generally, but I almost guarantee if I met every single one of you, I'd like you. It's just me. But in general, I just don't like people. Anyway, and someone I rate highly, quite possible they become a high-quality company with a great deal of future growth, I feel. Oh, he also mentions Bioxin. I'm wary of because of reports from other cannabis businesses, ECS of high competition, lack a lot of imported products from Thailand, pressuring margins. Maybe the other divisions will carry Bioxin. Longer term, I really like Veeam too, but even a fundamental guy like me has learned the hard way not to fight the short-term trend. Okay, so what companies were here? AG, Austin Engine, no, ANG. NG, I did have this on my watch list for a potential breakout. It's still on my watch list for a potential breakout. I just like how the share price has gone sideways for about, what's that? For a month and a half almost. When do they release results? If they release results, this would be a breakout candidate. But the other thing is, on the flip side, if they release a bad report, there's a chance the share price could drop. So that's Austin Engineering. And the other two companies you mentioned, Jumbo. So I'm a little bit different than you. I probably would not consider these companies to be high quality, but I did have a look at Jumbo and I thought there might be some value with Jumbo. I could even think there might be some value with Austin Engineering. And I used to be a value investor and I still am attracted to value propositions, but I also now have a look at the charts unless I think they're really deep value. So when it comes to Jumbo, I do like the very fact that I think there is a support level at 950. And if it's value, I have been thinking about it. The other one was LIC. This one for me is more of a trade just because they've had problems in the past. And yeah, they released results and the market didn't like it. So this is another case where, just like Austin Engineering, I thought there was a potential breakout. And in fact, the share price went the other way. So for me, this is more of a wait for a breakout before I get in. And Veeam, well, I got this one wrong. Well, not really. I just said I think there's a chance the share price might rally off the support level at 68 cents, and it's fallen quite below it. We have seen a little bit of rally the last 5 trading days, however. Robert John Reed. Hi, Nappy. Love your work. Also, being a member, however, the system you're using is blocking out some of the charts in the bottom right corner. Regards. Okay. And there was another one here. Here we go. From Samantha Dart. Thunder. Hi, Nappy. Been watching your videos regularly. Nice work and plenty to learn. Can you please move your picture in the videos from right-hand corner to left-hand corner? Right-hand corner has more relevant and useful information that many times gets covered by your picture. Left-hand corner, on the other hand, generally has nothing. So hopefully, this is on the left now. I've moved the picture. There's one, oh, that's not right. One little annoying thing about OBS is I can't move it unless I go into this. But in Zoom, I actually could move this, increase the size, decrease the size. Like I could increase the size the whole video. And that's one thing I can't do. Unless I had this on another screen. And I think that's what some people do. They have 2 screens and put the OBS on the other screen. They can manipulate the screen on the other screen. I might try to do that in the future. So thank you for that information, Robert, John Reed, and Samantha. And I do like these little tips or feedback. Feedback's the word I was looking for. Feedback. Okay, Paul LY says or asks, hi Neppy, are you still holding positions for MYG, which is Mayfield Group? Can you have a look at the chart? Is it changing structure? Okay, so I have taken profits with this one, but I have not completely sold out. The main reason I've taken profits is because there is possible signs of a structure shift. This chart for this one was beautiful. Look at this chart from, well, we'll go back even further, but a beautiful chart from, we'll say August through to January. It's a gorgeous chart. The share price dipped a little bit in middle of January, but then started to go up again. And then this next rally towards the end of January was not strong enough to get back to new high. And then we did see a little bit of selling pressure. Share price fell through the previous low, which is a bit of a shift in structure warning sign. So that is when right there, I actually put the right line. Right there was a possible shift in structure when the share price fell below that. And that is when I took profits. We saw a share price bounce and then pull lower. And this was another negative sign where share price got to another new local low. We've seen a bit of a bounce, but then we saw a bit of selling pressure on the 20th, so on Friday. Share price in actual fact down 6%. So a lot of volatility, taking profits, not completely sold out. This was one of the biggest holds. And the other reason, valuation. I just think it's getting a little bit overstretched with valuation. So a lot of multiple expansion alongside financial expansion. Anyway, so have taken profits, but not completely sold out. And typically in the past when I've done this, I've regretted it, not completely selling out. Just saying. We'll see if I learned another lesson. Okay, I've already spoken about one. Michael DJ. Utilities in the US are moving. Could explain AGL move in part. Now, AGL has gone, this is definitely, or was definitely on my potential buy list because when they release results, share price has gone bonkers. This is just a breakout of all breakouts. And I should have been paying attention or a little bit more attention to this one. I didn't realize this until a few days later. This was a beautiful breakout. And even since then, like after a three-day rally, I would think the share price would maybe find a little bit of weakness. It hasn't. A really strong chart for AGL, but I did not take a trading position, and I should, just based off this chart, just follow my rules. These are beautiful, and Michael might be right. Utilities in the US are moving, and yeah, I even think Origin, I think they chart looks good, has potential here. I don't think APL though, a little bit different. No, so the chart for what was it called? AGL is looking really good. Daniel Guyen. Did I pronounce that right? I don't know my Vietnamese names. I'm pretty sure that is a Vietnamese name. Hi, Neppy. Thanks for your work. I've been enjoying your educational videos. One question. I look at some of the major US tech companies such as NVIDIA, Alphabet. The P ratios are sub 40. But some of the ASX, their P ratios are much above 40. Like now we're talking about WiseTech 50, Zip. Well, I wouldn't even look at the P ratio for Zip. Zero, they're just guided to profitability. They all still even over 40 even after recent drops. Does this mean ours are overvalued? What do you think will be the fair P ratios for ASX tech stocks? Okay, so a good question. I think this is a really good question because it's absolutely true. Now, if we have a look at some of the growth, that's the main thing, growth of these companies. Like ProMedicus, their growth is just phenomenal. We're talking about 30% revenue growth and 40 to 50% earnings per share growth. And you don't see that in the tech companies in the USA. Even if you go to Zero, their growth is really strong. So we're talking about revenue growth, 20 to 30%, earnings per share growth, because they just become profitable, really high. What's another one? What about Technology One? So they've just released a profit upgrade, but their revenue growth has been between 10 and 20%, earnings per share growth between about 15 and 20%, and that's going to increase. So keep that in the back of your mind. And their P ratio right now is about 60. And WiseTech, their revenue growth has been phenomenal as well. We're taught about revenue growth between 22 and 32, earnings per share growth, well, as high as 30% growth over the last 10 years. But if you have a look, well, excluding NVIDIA, that's a little bit different. Their revenue growth recently has been sensational. And in fact, if you thought their revenue and earnings per share growth was going to continue at these rates, this company could be the cheapest company in history So earnings per share growth over the last 3 years, 157.9%, yet the P ratio is only 46.5. So the big question is, how much longer can this growth continue? And I think that's the question when it comes to NVIDIA. How much more can this momentum continue? It could continue for the next 3 years, or maybe this is it. But some of the other tech companies, Google. Now, when I bought Google, the P ratio was like 15 or 16. P ratio right now is 28. And revenue growth, actually quite nice. We're talking about 15% per year. Earnings per share growth has been about 30%. That's a little bit stronger than I was expecting. So you could say that Alphabet probably is better value than some of those other companies, and I would actually agree with that. I think Alphabet is in a sweet spot right now. Microsoft, their growth, revenue growth between 10 and 15%, earnings per share growth about 20%. It's actually quite nice growth as well for Microsoft. P ratio 24.9. I think there is a definite argument that some of these American companies are actually pretty good value as well, because they do have a fair bit of growth moving forward. Some people will say, well, the capital expenditure is out of this world high, and that is true as well. But the thing I wanted to get to was, I think some of the growth potential for some of the ASX companies are greater in terms of percentage changes than some of the American tech companies, which is why you do see a higher P ratio. And a good example of that is ProMedicus. I think their growth potential is higher than even maybe NVIDIA over the 5 to 10 year period. So I'm more willing to pay a premium for that growth. Fair value, I think it's dependent on each company. And I would say if P ratio for ProMedicus fell to 50, I would actually buy a lot. If WiseTech P ratio dropped to say 40, I'd buy a lot, say 30 to 40. Technology One P ratio dropped to say 40, I'd buy a lot. And the same is true for American companies. If I see the P ratio of those companies drops to say below 20, that is a buying opportunity. So it all depends on the company. Marists, hi Neppy, the volatility is driving me crazy. I feel like selling on Wednesdays and buying on Mondays. I've just invested in FAU at 1.6 cents. I'm assuming new gold miner just starting production. I found it by looking at directors' transactions in market index. Do you want to give me your thoughts? No, I don't really. Okay, let's move on to the next one. No, I'm joking. I am joking. The thing that fascinated me about this particular comment is the just starting production. Now, just that in itself doesn't necessarily mean this is an absolute buying. Share price is at 1.6. I'm assuming they have a lot of shares on issue. I'm going to say, well, I don't know, because 3.35 billion, market cap is 53.63 million. So either they had a lot of shares on issue, or this company had a really low market cap for a miner just gone to production. Let's have a look. Just did a capital raising. I'm assuming they just gone into production, so that means there's no cash flow just yet. I could be wrong. So let's have a look at the most recent Appendix 5B. Nothing yet. And change of directors notice. Did they participate in the capital raising? Which they probably did, which is probably why you seen these change of directors notices. In fact, if we have a look at this particular capital raising, so this is the first time I look at this company. I like when they say sophisticated investors. It's sort of, they're not really sophisticated. They just got a lot of money. Just because you got a lot of money doesn't mean he's sophisticated. And yeah, here we go. So the directors bought a fair few shares. Advancing exploration programs. Okay. So according to this, I don't think they're in production just yet. They're going to consider expanding their project portfolio. Okay, so Advanced Gold and Base Metals Exploration Company. Gimlet Gold. I just don't like to know when they might go into production. And I'm not seeing any announcement here to say they've gone into production just yet. Let's have a look at the chart for this one. If I can find it. FAU, First Australia. Ooh, look at that chart. Nice. Share price has pulled back a little bit. Chart doesn't look half bad. Nice little bit of volume on the rise, and the volume has really dried up. That's could be a good sign. Nice chart. I'm going to put this into my watch list. Add to my watch list. What would I put it into? We'll put it just into mining. Okay. I think we can move on. Mr. Blue Green, what is that volume indicator that you use in TradingView? Thanks. This volume indicator is just volume plus the shaded is average volume. That's all it is. It's just volume plus average volume. And I can't remember how I put the average volume on there. All I remember doing is putting it there. I do like to have a look at average volume, although, to be honest with you don't really need it because you can see the volume has increased for FAU here. But it does indicate that volume for FAU was significantly higher than normal back then. And right now it's actually lower than normal. But if I just click on the volume, inputs, oh, this must have just been an MA thingy and I just dragged it into it. Because I don't even have... or maybe it was just the volume and it was the show MA was included on it. Yeah, it looks like it was. There was just an MA feature in that particular volume thingy, whatever you call it. Anyway, it was just our average volume. I'd like to know what the average volume, how many days it is, because that's important. Paul L. White. Hi, Neppy. SRG released its half-year report. I'd like to hear your opinions, and is the current share price still good value? I thought their report was pretty good, but apparently their numbers was just slightly below expectations. And what I'm going to do right now, and I'm going to get to Gemini. So Gemini just improved their, here it is. And I've now been doing this a little bit more because AI has this capability, SRG on ASX results compared to expectations for half year 26. Hopefully that's right. So I looked at this yesterday. First time I've done it is I just wanted to know how the results compare to expectations, that sort of thing. And Gemini actually gave me pretty good results, not for one. I think it was Alliance Aviation. It said the share price was down because of one-off. That was not the reason why the share price was down. And here we go. Let's have a look to see. So they gave me the right date. So don't blindly believe everything you read on AI, but they're getting better, hallucinations, that sort of thing. And in the past, I used to ask AI these questions and it used to give me the wrong dates. It was looking in the past, looking at the last 4 year or 2 years ago, but it hasn't definitely improved. So it says SRG results were a mixed bag. If I remember it slightly missed expectations. I thought the numbers were really good, like revenue up 20%. In line with the consensus, underlying EBITDA up 20%, but it was a 3% miss versus Bell Potter, which is just one analyst. EBIT up 26%, fall below some broker forecast. Dividend met or slightly exceeded expectations. Working hand record high up 24%. So the miss factor, yeah. That's right. They also issued a guidance upgrade, and typically when a company issues an upgrade, share price should rally. So I thought the share price was going to rally, but it didn't. In fact, the share price dropped for SRG on that particular day, down 5%. I thought that was a really interesting reaction from the market. So I thought their results were really, really good. And again, I'd say this is more of a cyclical company. You can just see share price rallied on that day. Yeah, that's right. The share price was down a lot at one point. And I should have been a little bit more nimble because I do think that was an overreaction, and that's why the share price has rallied. Now, the chart here, it's okay. It's been a beautiful chart for a while. I have been trading this in the past. I did trade this, and I got it out way too early. I thought, valuation is probably a little bit too high for me right now. But with the growth they've experienced, P ratio 32.8, according to TradingView. Anyway, so I thought the results were good, but a slight miss to expectations while the share price did drop. Well, you said, is the current share price still good value? Okay. Is the current share price still good value? Like I've done this in the past. Have a look at SRG Global. Just have a look at the financials. Really good revenue growth, earnings per share growth a little bit lower. I'm wondering if that's because of dilution. So we're talking about revenue growth, roughly 20% per year. Earnings per share growth, a little bit less than that, although the last 3 years have been really good. So this company has really taken benefit of the really good conditions in mining. Says P ratio 41, but that might not include the new results, I'm assuming. Return equity and return invested capital below what I look for, but that's a 5-year average, and I'd say those are back above 10%. And margins, operating margins, much lower than what I want in a high quality company. So SRG, I would not consider high quality, more of a trading stock. And the reason behind that is they are a mining services company. A little bit more than that, maybe. Engineering services, construction services, but even maintenance and industrial services. I still think there's a little bit of cyclicality in there. And you will see the share price have the potential to drop. Now, this is the weekly chart going back a lot. I'm not sure if it is the same company, but share price did drop a lot between 2011 and 2016. That was during the downward cycle of the mining period. Share price as low as 20 cents back in June 2020. There you go. I haven't helped you at all. P ratio, maybe the P ratio is a little bit elevated for this type of company. Maybe. Designation 8. Could you do a chart analysis of Chewy? Is it worth buying and would you buy? Okay, so this is just a chart analysis of Chewy. Do they sell Chewy foods? I have no idea. Chewy, NYSE, retail trade, internet trade, online retail of pet food and other pet-related products. Interesting. Pet food and stuff. Okay. First thing, okay, just based on the chart, I would not even think about buying this. Just based on this chart. There was a little bounce, but there was no volume at the low. I would like to see some big volume coming through here. That would be suggesting that the market thought there was really good value at that level. No volume. The one-day chart or the daily chart looks bad. Weekly chart. You can see a lot of interest in this company back in 2020. Share price up to 120. But even on the weekly chart, it was looking a little bit interesting about a year ago, but nothing more to say. Is this company high quality? Well, just based off the weekly chart, I would say no. But we don't have much time here. We've got 6 years of history. So it's hard to know if this is a high quality company. But based off this, I'd say no. I would not classify this company as high quality. Now let's have a look at some numbers. Revenue growth, 8%, 14%. Earnings per share growth, 104% in the last 3 years. They might have had a one-off in there. Earnings per share growth over the last 5 years, 2.4%. P ratio is quite high, but maybe that's because of a one-off. And debt, looks like they had net cash. Margins, operating margins 1.6%. You would expect that to climb, but that's too low. And return equity, return invested capital, 5-year average is nonsensical, like return equity 5-year average, negative 48%. So just based off that, not a high quality company just yet. Market cap is $10 billion. And I would assume they've got pretty nice revenue growth. Yeah, look at that revenue growth, but maybe petering out just a little bit. $11 billion of revenue growth, and their profits, not much there. So they weren't really concentrating on profits back in 2019. $3 billion of revenue, but unprofitable by $270 million. They just didn't care. We don't need to be profitable right now. But this is the point where they need to show that they can produce a profit, I think. And also, I'd like to see a little bit more revenue growth. Let's have a look at the quarterlies. Our revenue is growing very slowly. Yeah, anyway. But based on the chart, I would not be interested. If I saw this daily chart, I'd move straight on to the next one without even a thought. That's just me. That's just the way I look at it. Ben Hutchinson. Oh, this is a really good study of having a technique, having a plan, having plans. So Ben, planning to start a new practice to improve my investment decisions. For each trade, I'm going to write a log entry recording what the trade is, i.e. stock, amount, price, and the rationale. Then wait one day before actioning the trade, although I can back out if I have second thoughts. Hoping this will reduce impulsive trades, such as catching falling knives, where I act with too much emotion. Experience shows my emotional trades seem to perform worse in hindsight. I think that is really smart. I think it's a really good. I think the most important thing here is understanding yourself, understanding your weaknesses and strengths. Ben obviously understands some of his weaknesses, and actually writing down a long entry is really important, even for those, I think, including those you take a position in. So just writing down why you've taken a position in a company and why you would sell out. I think that's really important, why you would sell out. For instance, for my trading positions, I just have where the share price drops. But for my longer term, so for instance, what's a long, NVIDIA. I do own NVIDIA, Google, Alphabet, Microsoft, and my sell hypotheses or sell reasons for getting out of those companies is significantly different. It's not a sell price. It's not, if the share price drops to this level, I'm going to sell out. In fact, if the share price drops a significant amount, I'm more likely to buy. So completely different reasons for buying, selling, depending on what type of company it is. So what's a good reason to sell out of Microsoft? A good reason to sell out of Google. A few years ago, there was a lot of concerns that AI will destroy their search functions, like Google. Destroy Google. Well, that's never going to happen. But they're leading. Google right now is leading the AI charge. But that was not a reason for me to get out a few years ago. In fact, that's why I bought, because I thought the market was overreacting. But anyway, and maybe there could be a competitor for Google. Or maybe another company like Microsoft will completely destroy what Google's trying to do. Or NVIDIA, not NVIDIA, Tesla. So a lot of people are really interested in Tesla because of robo-taxis. It's a real thing. Apparently Australia, it's illegal for self-driving cars, which is stupid. Anyway, so self-driving cars are becoming more and more used in the United States. In fact, I was listening to one guy, he lives in San Francisco, and every single morning when he drives his children to school, they count the amount of Waymos. And he said it's up to like 10 to 20 now each morning, the amount of Waymos on the street there in San Francisco. And it's just going to increase and increase. And eventually Tesla will be using robo-taxis. And some people think it's going to revolutionize the way we look at transportation. Anyway. Okay, so fishbowl. Oh, I think I've already talked about this, haven't I? Yeah, Pioneer, what's it called? Pioneer Credit. Share price did drop. Now, the share price did rally on a Friday, but I decided to get out because, just the market told me to get out of this one. And just cashing my profits. I was happy to buy or cash in my 50% profits. And yeah, the share price did go up 1.55%. Okay, not a lot. Anyway, so it's just a little bit of shift in structure, a little bit of negative sentiment in this one. But if the share price starts to rally again, I might actually add. I might buy back in. Maybe this was just a bit of a blip. But in this case, I was listening to the market. And the main reason I do that is I have my rules. I stick to my rules. And sometimes your rules mean you get out of this potential situations like this. But the share price could keep on going down. Massive volume the last 2 days as well after the release. So that's interesting, the massive volume. I'm not sure what that means just yet. Talked about Osco Healthcare and XRF. I'm just going to have a look at XRF. Just going to have a look at XRF just because the share price has decreased. I think it was 3 days in a row after the results. Yes, so this is looking a little bit weaker now. Share price has just dropped below a long-term uptrend. Now, if we do see the share price rally on Monday, this could be a nice little buying opportunity for XRF Scientific. Just saying. Okay, this is one of the more interesting comments. I am Meeka. Does a disciplined sector rotation strategy in Australia, buying sector ETFs when they're out of favor and undervalued, then rotating out when valuations normalize, actually outperform a simple ASX index over the long run? Is there research done on this if you know? I had no idea when reading this particular question. And you know what I did? And this just shows you the power of AI right now. I just asked this question. In fact, I put your comment into AI. And the answer, or short answer, is theoretically yes. Practically, it's a minefield. But I don't really care about the reasoning. I wanted papers. That's the main thing I'm looking for, is papers on this. And so I just said links to the research papers. So here is one. So rotation strategies and their role in the Australian market. Yeah, so you can have a look at this. So fairly long paper, 19 pages long. For instance, one section here is, do sector rotation strategies work in the Australian equity market? Exactly what you're looking for. There you go. In fact, what I wanted to see here is their results. In fact, I'd never got to that because I was so excited that there is research papers on this. But I did not have a look at the results. Conclusion. Mirroring what we have seen in our study of sectors. By the way, I could have just pulled this into AI and just gave me the conclusion without me reading it. Mirroring what we have seen in our study of sectors in Asia, ex-Japan, both the sector price momentum and cyclical defensive sector rotation strategies achieve better than market returns in Australia. Shows that sectors with stronger price momentum in recent months tend to outperform in coming months, and the opposite holds for the sectors with weaker price momentum. So it's all about momentum, which sort of makes sense. The analysis of cyclical and defensive behavior among Australian sectors shows that Australian sectors perform with cyclical and defensive characteristics in global economic up and down cycles, respectively. But that was not the only one. There was another article here. So this is from, looks like 2016 to 2018, dynamic asset allocation using systematic sector rotation. Oh no, I did not have a look at this article. Here we go. Accept all cookies. And their conclusion, which I can't see here, that's all I'm looking for is conclusions. In fact, did they mention the conclusion here? Yeah, they did. I shouldn't have been looking at these articles. So the finding in that Tanny and Sensetti, the researchers argue that sector returns are path dependent, not random, and that systematic rules, specifically those based on alpha and relative strength RSI, consistently outperform a buy and hold strategy. One in 2020 from the ACFR, the myth of sector rotation. They argue that even with perfect foresight, predicting the business cycle exactly, sector rotation only generates about 2.3% outperformance, which quickly dissipates after transaction costs and tax. So less favorable with that one. And there's Vanguard ASIC research, a review of research on the past performance of managed funds. About half of all funds or studies found no correlation between good past performance in a sector or fund and future results. It notes that frequent swapping would not be an effective strategy due to the cost of swapping. Anyway, so yeah, don't discount AI because it can give you some really good information. That's exactly what I did because I couldn't find any research. And what I would have done in the past is I would have gone to Google and actually written a comment and asked me for some papers on it. And I would have had to go through quite a few papers to find it. So now we have this tool to more effectively use our time. Anyway, I think that was a good answer. G50. For the third time, I think it's from all the same person, by the way. The third time I've seen this ticker. So G50 is G50 Corp. And look at that chart. That's a weekly chart. So up significantly in the past week. A really good day on Monday, up 15%. And what I saw after that is really nice. So even though there's a little bit of volatility in there, share price just went up. A really nice little flag or pennant. So G50 chart looks awesome. I can't say anything negative about that chart, James Nicolo. It's a pretty good little chart. Talking about James Nicolo, SEG, Sports Entertainment Group, standout result of the day is come dividend. Buy now and receive 13% dividend. Amazing turnaround in his business over the last 2 years. I had a very quick look at this one. They released their results after training had finished. Was it on Thursday? It was Thursday. Oh, no. After training had begun. Sorry, after training had begun. That's right, after training had begun. And share price has rallied nicely. Anyway, so I had a look at I'm trying to figure out exactly what they do. So I thought they owned some sports teams, but they own sports media stuff. Anyway, so where is it? So profit 5.9 million for the year. Underlying EBITDA 11.9 million. Underlying EBITDA, we'll have this pre-AASB 116, but profit 5.9, EBITDA 11.9, $5.3 million in depreciation and amortization. In fact, what we might do is just have a look at their report. Why not? Sports Entertainment Group. Sometimes in their report they will tell you what they do, but no, they don't. Well, yeah, Perth Wildcats. That's it. They own Perth Wildcats. A little bit of Perth Wildcats. Yeah, I knew that. I knew they owned a sports team. Sports media, content and entertainment business which through its other complementary business units has capabilities to deliver brand stories to national, so media content. Sort of like I'm finance content or ASX content. Okay, what I wanted to do here is just have a look at their financial statements, which I have not done yet. I quickly glazed over this. I thought it was good on initial look without looking deeper. Okay, so revenue 73 million. Nice growth there. Profit for the half year, 3.3. So that includes taxes and tax from discontinued operations. So $3.3 million in profit. Okay. Assets, $74 million in assets. So that's net assets. That includes liabilities. So the market cap of this company, I'm presuming it's like 90 million. Oh, there you go, 89.88 million. So they've got a fair few assets, and $62 million of assets are intangible. Fair bit of cash, $26.7 million in cash. Any borrowings? No. Balance sheet looks nice. And cash flow, $11.6 million in operating cash flow. They did pay some assets here. Net proceeds from sale of control. That's why they've increased. Oh, they've sold a little bit of their interest in Perth Wildcats. There you go. So a lot of cash on hand, and that cash flow is really nice as well. Yep. So the one thing when I looked at this chart, or this company was just a chart, was like, it does look like it's illiquidity traded, but nice volume. So this is what I like to look at: illiquidity trade company, and then some really good volume coming in. That is good. You want to see more volume coming through. If you have a look at the trading of this company recently, just go to trade history. Yeah, there are many days it doesn't trade at all. So you do have to be aware of that. In fact, there was a period here, like a 13-day period, where there was only 2 days of trading. And some other days, a very little amount is traded. So you want to see a volume increase, unless you plan to hold it for the long term and you don't care about liquidity, which is a benefit of being a retail investor. Sometimes you don't have to care about liquidity. One of the things that really disappointed me, maybe not disappointed, one of the things that peeved me off is when those experts on Ausbiz or Call would look at a company that is liquidity trading and say, no, it's too illiquid for me. They're getting that viewpoint from a fund manager, not from a retail investor. And I sort of understand why they would be against those sort of companies, because they couldn't take a significant position in a company if they're a fund manager. But if you're a retail investor, it doesn't matter if liquidity doesn't matter if you're in it for the long term. This is the weekly chart. And you can see the weekly chart here. This company's done nothing. But maybe this is the turnaround. Sam Bessel says, how do you become a member of this channel? There should be a member button. In fact, the other day, I was looking at some YouTube. I'm just looking at my different computer right now because I don't want to show you anything. The videos I usually watch, which is not investor related. Although Eric Dane's final message to his daughters and the world, famous last words. Oh, he died, did he? And I was looking at a lot of videos on the California avalanche. Anyway, okay, so I'll just show you this. I'll just show you this and see. Where's YouTube? No, I want YouTube video. To show you. Oh, Stephen Van Meter. Okay. I'm pretty sure if, see if you go to the homepage and you can subscribe, but I'm pretty sure there also, if Stephen Van Meter had a member tier, there will also be member link here. I'm pretty sure about that. I could be completely wrong, but I'm pretty sure. What's a individual? Two back-to-back, a lot of avalanches over there. David Blaine. Well, maybe David Blaine has a member.
Here's the move, and I'm going to teach it to you.
No, I don't want to subscribe. No. All I need
is
someone who has a membership thing. Stacy Silver Screen. Let's see her, whoever she is. Not subscribe. New York Post. Anyway, I'm pretty sure that is how you become a member. That's the easiest way, I think. I could be wrong because I saw that the other day. I just saw this member link in one of the channels I was looking at. A member button, anyway. Chris Murphy. Hi, Nebby. Did you or are you buying any tech stocks in the sell-off? I am so close. So close. And I should be nibbling. I keep telling myself I've got to nibble, but I'm getting a little bit greedy, saying, I think that maybe the share price could drop a little bit more. Like Technology One, share price has bounced. They had a really good upgrade. So I'm so close to nibbling in some of these companies because this is the time to be buying, I think. ProMedicus is definitely on my wish list. Technology One, WiseTech. Those are three companies I'd be more than likely buying or adding to my positions. So very close. Blacktop Images, the recent fear in AI taking over every tech company, causing an order dive. Well, what about AI will actually change? But what AI will actually change is legal services like IPH. Interesting, because what IPH do is exactly the benefits that AI brings to a company like IPH. Yeah, so maybe they can get rid of a lot of their lawyers. So they go through massive data sets, don't they? So IPH or the patents would have massive data sets. Anyway, so I actually did put this into AI as well. And this is what it said. This is what Gemini said. In fact, it called you astute observation. Why IP firms are the ground zero for AI value. Intellectual property is uniquely suited for AI because it sits at the intersection of massive data sets, global patent, trademark registries, and rigid linguistic patterns. And it also mentioned here, there's going to be some leaders and laggards, and there's some companies that are really going to benefit from this. And for a group like IPH, AI acts as a force multiplier. It allows them to maintain a single source of truth across different legal systems, assuring that a trademark filed in Sydney is instantly checked against emerging risks in Singapore and Vancouver using the same governed AI framework. Also, it gave me a video, how AI is changing the future of IP law. I actually did click on it, not many views of that channel. So there is a possibility that AI will significantly help IPH, but we just don't know that right now. And the results were, I thought, okay. We haven't really seen AI affect this. Most of the share price decrease has just been company specific. and no real breakout for IPH yet. Happy now. Thanks for another video and well done on the quick zip play. Personally, I loved it ending down, just like the ProMedicus people calling lows and catching falling knives over and over again. And then they will be out in droves saying they are back. Well, funny enough, I'm thinking about buying ProMedicus, but not Zip. It's interesting because Zip, this has happened to me now 3 times in the past 5 years, where I've day traded Zip, and every single time I finished out the day trade, I've gone, nah, I don't want to do this anymore. But I've done it. Yeah, I did it back in 2020, and then I did it again. I think it would have been 2021 or 2022. I forget. Oh no, I think it might have been July 2022. I was just day trading it, and I have traded this in the past, Zip, but it's always a trade. I would not own Zip for the long term. I just see so many futures for this company. Some of the futures are really bad. Some of the futures are pretty good. But at this point in time, it's just a trade for me because at this point in time, the market's saying the future is really bad for Zip. And I do think eventually the sentiment will shift. And then I would more likely trade Zip. Zip is not a high-quality company. There is no way I could even imagine Zip being a high-quality company until it proves itself, which may not be for another 5 or 10 years. And then at that point, Zip might not exist. I just don't know. ProMedicus, however, is a different story. Kelly Ma asks, hi, Nappy, do you like the chart of Terra Metals? Yes. Without even looking at it, yes. What are your thoughts of TM1? Looks like Platinum Group Element, big discovery. Thank you. I'm fond of all your videos. Very helpful. Without even looking at the chart right now, I do know this one, and I looked at it within the last, within the last week, and I went, oh, this chart's so good. Such a good chart, but I'm not trading. Although I think I'm trading this. I have a feeling I'm trading this right now. This is bad. Let me have a look. Yeah, I'm trading this right now. I'm in Terra Metals. Yeah, that's why I know this chart, because I'm trading it. For some reason, I thought I'm not trading it, but then I had a look at this chart and went, no, I'm trading this just based off this. Yeah, so this is one of my trades right now, small cap trades. That's interesting. Sometimes you're completely dislocated from exactly the trades you look at. But what I do with my small cap trades is I don't actually have a look at the company name. I just have a look at the chart. That's all I do. So if you go through my small cap trades, yeah, there it is. I just have a look at the charts. Like this is Apollo Minerals. Nah, not selling that one. Red Castle. Nah. What's this one? Sunshine. Nah, still looking good. Star Pharma. Still looking pretty good. So just then I had to look at the name, but mostly when I go through these charts, I just have a look at the chart and decide on the chart, not the name. Anyway, so for me, I'm a bit biased because I'm trading it right now. So the chart looks fantastic. Now, there must have been a reason why I took a position in Terra Metals. And funny enough, even the reason is not of interest. So it would have been one of these announcements. I think I would have bought. In fact, I'm going to see exactly when I bought. That's a good thing. I can actually see. Well, I go to my my superhero account, and it'll tell me exactly how many days I've held it. Or I could look at my activity. I've held it for 24 days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. So I bought it around here. So about 18 cents. Let me have a look. Yeah, around there. Anyway, the chart looks good. And I don't know why I bought. Yeah, Platinum Group Metal. By the way, Platinum Group Metals, what happened overnight in this space? I did see a lot of green. The Platinum Metals, yes. Palladium up 5.15 and Platinum up 5.19. Good going. Good going. That's all I got. Oh, and finally, Meeka, Korea, 10% up. Don't know why. Your thoughts? Sometimes share prices of companies go up or down. On no news flow, there's no reason behind it. It just goes up and goes down. It's sentiment. In the short term, when there's no news flow, it's just sentiment. And obviously, this particular merger with Aura, the market just doesn't think there's anything of value there. And that's it. And I think the share price will be bouncing around for a while. Some days it's going to go up, some days it's going to go down. And we've seen a lot of volatility in this one. So this is, for me, is just sentiment, just negative sentiment right now. And on occasion, when there's negative sentiment, you will see a bounce. We've seen that a lot with Korea. So that's it. Negative sentiment for Korea. Okay, that is all I have for today's video at an hour and 30 minutes. Hallelujah. If you have any questions, any thoughts, leave those in the comment section of the video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.